Hi and welcome to this week's Property Insider video where Dr. Andrew Wilson and I discuss a game changer, the relaxation of lending which should underpin our property markets. We'll also talk about how the Melbourne property market has opened up. But what does that mean? Is it going to really rebound like the other states? And maybe it won't. We'll explain why. Of course, Dr. Andrew Wilson is going to share all his data with us as well, including what's happening to the economy, what's happening to the labour force, and what's happening to property around Australia. If you want to keep up to date with what's happening in our property markets, please subscribe to this YouTube channel and click the little bell icon so you can be kept up to date every time our weekly Property Insider show comes out. Something very interesting changed last week, and it's going to underpin the rebound in our property markets in 2021. Now, you're probably familiar with the term responsible lending these days. After all, the Royal Commission hammered home the point that banks weren't being responsible lenders. Now the government's done something of a backflip on their previous stance, where it's going to dramatically change your and my access to finance. In a nutshell, Federal Treasurer Josh Frydenberg has announced sweeping changes to remove some of the overly restrictive responsible lending rules. The goal is to make borrowing easier, make it more efficient for everyday Australians, and I guess that's in an effort to increase the demand for credit and to stimulate our economy. And we know that loosening the bank's shackles in lending is going to do more in supporting the property markets than another cut in interest rates. So I'm looking forward to my weekly chat with Dr. Andrew Wilson to hear his views on this, as well as lifting the restrictions in the Melbourne property market. And of course, I'm keen to see his charts when he explains what's happening in our property markets. Welcome, Andrew.
Thank you very much, Michael. Yes, it's been an interesting week, and it might even get more interesting next week, but we need to wait for that one.
Well, that'll be the budget, so we'll have some fun things to talk about. Well, having been involved in property for over 40 years, almost 45, 60 years, I've seen credit policies go from one extreme to the other. When I first started investing, Andrew, and you were around at the same time too, you're a little bit younger than me, but it was hard. You had to put a suit and tie on, remember that? You visited the local bank manager. Then over the years, the lending became easier. And prior to the global financial crisis, it almost became too easy. Almost anyone who could go online could get a loan. They didn't even have to really prove their ability to service the loan. And then, of course, there were the restrictive lending practices introduced in 2009 after the global financial crisis. Lending became even tighter following the Royal Commission when banks were fined billions of dollars for a range of misdeeds. Currently applying for a loan similar to having a forensic investigation, some would say this pendulum swung too far. And I've often said property investment's a game of finance with some houses thrown in the middle. And if banks are going to free up finance, more people will be able to borrow and the property market will rebound. Now, I know it's important to have responsible lending, and so we're going to discuss that. But first, Andrew, before we get into the new world of finance, maybe we could have a bit of an update on what's happened in our property markets over the last week.
Okay, let's have a look, Michael, at what's happened in our housing markets over the past week. And we always start with the weekend auction markets. Some more positive results again in most of our auction markets. In fact, even the Melbourne market lifted to some degree in terms of the number of auctions. But we'll start with Sydney, Michael. Another strong weekend for Sydney. Those clearance rates continue to rise. They're now well and truly entrenched in the mid-70s, 70% range. So we would expect to see upward pressure on prices with those sorts of clearance rates continuing, and listing numbers are also quite high, around about where they were a year ago. Of course, we know and we've explained that a lot of these are the new online listing marketing technique. So, but still, there's plenty of properties going under the hammer, whether they're in open air environments or digital environments, and clearance rates are continuing high in Sydney. Melbourne listing numbers lifted on the weekend, Michael, still very low, of course. If we look back to a year ago, that was the grand final weekend. That's why those numbers are low for 2019, but certainly a big lift compared to the previous weekend. Numbers are still low, of course, and we need to understand that I actually published a clearance rate on the weekend because numbers are getting a little more reliable, but that low clearance rate does reflect a still high proportion of withdrawals in those reported auctions. But look, certainly a start, and perhaps we could maybe feel that this is the bottom of the market, but we will look at those listings going forward. Smaller markets are doing well as well, Michael, similar to Sydney. Canberra's been very strong this year, consistent clearance rates above 80%, and also Adelaide's been a quite a solid performer. And those Brisbane clearance rates, although a little lower than most, we know that that's typical for the Brisbane market. But when we look at some of the other data shortly, we'll see that that Brisbane market is really starting to hum along at the moment. So auction results trending still upwards overall, and maybe some early signs of an improvement in Melbourne there. Clearance rates for Sydney, we can see that trend has consolidated and now rising above 70%. And we can see the results for the regions in Sydney. Northwest was number one on the weekend, the Hills District in Sydney, over 80%. And interestingly, Michael, most regions recorded clearance rates close to or above 80% in Sydney. So some consistency there in regional results. Had a big result in Sydney on the weekend, Michael. We had a beautiful property in Vaucluse sold for over $24 million. And the word was that was actually $10.5 million over the reserve. Top end properties finding buyers, probably not as many as a year ago, but they were the top 10 sales for the weekend in Sydney. Clearance rates in Melbourne, as I said, recorded a clearance rate for this weekend. Numbers are starting to push upwards, still very low. So we'll need to watch out for that going forward. And I think the key there is the listing numbers. We can see listings a year ago, that low listing is the grand final, as I mentioned before. But we can see how listing numbers have dropped through the lockdown period in Melbourne. But just an indication there that they're picking up. So let's look at the numbers going forward here. And that will give us, I guess, the early sign that markets are starting to revive in Melbourne. New listings, we look at those new listings every week, Michael. This is the daily index over the past week for newly listed properties nationally. Are starting to rise again over the past few days, Michael. So seller confidence is regenerating after a slight dip the previous weekend. But we've got to understand we obviously have fewer new listings coming through in Melbourne because of the shutdown, but perhaps that's a sign along with those auction listings that overall new listings in Melbourne are starting to rise as well. And if we look at the year-to-year change with new listings, still below where we were a year ago, Michael, around about that 10% fewer. We know it was a strong period a year ago in the market. Markets were starting to rise, but we need to account for lower numbers of listings in Melbourne. And if we look, listings actually did rise in Melbourne over the last week, Michael, up 11%, but of course from a low base, and new listings in other markets were relatively stable. If we look at the relative position, Melbourne around about half the new listings over the past week in terms of volume compared to Sydney. Other capital city markets tracking around about at the same levels we would expect given the difference in the population. Also newly reported sales over the last week, Michael, which we do record. And we can see Sydney's new sales, weekly sales, are on the roll, consolidating from a rising position. So the trend is clearly up there. With Melbourne, we know that new sales, no surprise, have fallen away during the lockdown. But again, some perhaps positive signs, Michael, that the Melbourne new sales data is consolidating. Roughly the same number of new sales reported over the past week as the previous week. So perhaps we've found the trough there in terms of that decline in new sales. Brisbane rising quite strongly, Michael. We're seeing a real surge in new listings in Brisbane. And as we mentioned, Brisbane tends to be a second half of the year market, and strong new sales reported in Brisbane over the past week. And we can see that reflected in the weekly change. Brisbane up 6.1%. Melbourne and Sydney are steady, Adelaide up and Perth down. But certainly that Brisbane market is building ahead of steam at the moment. And we can see that with new sales up 6% over the past week. And the relative position, we can see that Melbourne sales volumes are well behind Sydney, significantly lower than the new listings compared to Sydney. But the others, again, are similar to their population relationship. So quite an even market there in terms of activity levels compared to Melbourne, of course. But we have perhaps some light at the end of the tunnel for the Melbourne market going forward, which we'll talk about shortly. The economy, of course, our share market continues to consolidate. No real signs of any volatility there. Perhaps even a rise there coming forward over recent days. The Australian dollar, I think this is interesting, Michael, dipped over the past week. I think this reflects the announcement, or I guess the scuttlebutt now that those drums are beating even louder, that we will get an interest rate cut next week. Of course, lower rates always mean a lower currency relative to what's happening with rates around the world, or interest rates around the world. But the dollar picked up again. That's the latest data. But I think that was a sign that the market believes there will be an interest rate cut next week. And I also think some of that easing in the dollar was also because iron ore prices came off their peaks as well. But certainly a good sign there. We'll get an interest rate cut. We looked at the latest unemployment rates last week global for the whole for states, and for the nation, Michael. And of course, we did have that sharp decline in the unemployment rate over August. This is the position of our capital city markets. We can see those smaller markets have lower unemployment rates. Sydney's still the standout in terms of the larger capital city markets, which all recorded quite steady unemployment rates over August. And I think we're looking also at some more interesting data here, Michael, which paints a deeper picture of labour markets. And we can see there that the Sydney market over August, actually we had a very strong increase in jobs growth and also returning to the workforce as well. So, and most of our markets were similar to that, Michael, with not just jobs being created, but people deciding they could return to the workforce and look for work, which is a positive sign. Of course, the offset to that is clearly Melbourne there when we look at that, Michael, where we see jobs continuing to fall and the participation rate, the labour force shrinking as well. So I guess if we had to put that into some context and offset that shrinking labour force, the Melbourne unemployment rate certainly would have been higher over August, but we shouldn't be surprised, obviously, through the depth of the shutdown that we had more job losses and we had people leaving the workforce. We also had some very interesting data out last week, Michael, in terms of the March migration data. We can see that migration in Victoria and New South Wales has continued to fall quite sharply, but the Queensland migration is steady and now well ahead. Queensland net migration over the year ending March is well ahead now of New South Wales. Another interesting result was Western Australia, Michael. We're seeing a real surge in migration back into Western Australia. I think that's a sign that we'll start to see more demand for property in that market and higher prices. But certainly that downward shift in migration in the major state, or in New South Wales and Victoria, has continued. And of course, we will expect that to be severely impacted by the shutdown over the next year or two. But I thought it was interesting just to look at migration versus house prices, just to finish off, Michael. And we can see, although migration certainly is an important factor in generating demand for property, it's certainly not the be-all and end-all. And I think to some degree, there's been a little bit of overstatement as to the impact of what we will see in falling migration on house prices and housing market activity. It will have an impact, but I think it won't have the sort of impact that some have predicted. And we can see there that net migration over the year to March in Sydney and Melbourne, and that should be New South Wales and Victoria, has fallen quite sharply, increased in Brisbane, Adelaide and Perth, as we saw before. But if we look at house price growth, there's really no correlation in that same period. In fact, prices grew quite strongly in Sydney and Melbourne over that same period, the year to March, and they were flattish in the other capital cities. So even though we had strong migration in those states where those capital cities are located, it didn't impact house prices. And similarly, where we had significant downturns in migration levels over the year in New South Wales and Victoria, it certainly didn't impact house price growth. So we really need to look at those internal factors such as local owner occupiers and the nature of the cycle before we start writing off our housing markets and house price growth, with the prospect certainly of lower migration going forward. And of course, as we alluded to, Michael, some news there which are big news for the property market if it comes to fruition, and that is the growing likelihood of an interest rate cut next week, down from 1.25 to 1.5. That'll certainly result in lower mortgage rates and improved affordability if it does occur. So it is scuttlebutt at the moment. And as you mentioned at the beginning, Michael, the government has eased lending restrictions that were introduced during the GFC, and they were reinforced, as you said, by those APRA credit squeeze policies of 4 or 5 years ago, and of course the Banking Royal Commission. So the question is when they will be introduced, but when they are, they'll certainly have a positive impact on our housing markets. And Victoria has also announced some good news for the local real estate industry. Live property inspections are now allowed, restricted to 2 buyers and 1 agent per inspection. And however, open air auctions are still banned. But I also believe that valuations and estimates now can also be conducted with vendors. So some good news there for the Victorian market going forward. And the news is certainly overall positive, I think, Michael, for this week's update.
A couple of things came out of that for me, Andrew. One of them was that migration does create demand, but maybe it doesn't create demand for houses to buy, because migrants, especially overseas migrants, start off being tenants and they also only go to certain sectors of the market. So clearly, as you said, local factors, local supply and demand, local consumer confidence, the economy, those factors are probably even more important than migration in property price growth.
Yeah, absolutely, Mike. That's not to downplay the significance of migration, but I think that we need to look at that as one of the factors going forward. And even if you look at the volumes there's 45,000 net migrants over the year into New South Wales. They are all not heading for Sydney. They are individuals, they're not households. So by the time we actually saw the net result in terms of purchases in Sydney, we might struggle to get 10,000 sales out of that, maybe 5,000 sales out of a market that can push up to 100,000 sales in a year.
Oh, no doubt the government is going to increase migration again once the borders are going to be able to be open, because that's one of the ways of getting our economy going. More people getting jobs, more people spending, more people paying tax. But I think the big game changer this week, the thing that is going to underpin our property markets, is the fact that Josh Frydenberg said the Morrison government's implementing the most significant reforms to Australia's credit framework in a decade to increase the flow of credit to households and businesses, to reduce the red tape and to strengthen the protection for vulnerable consumers. So clearly the Morrison government's wanting to grease the wheels of industry, of our economy, of our recovery, and it's going to help homeowners, investors and business owners too, isn't it?
Absolutely, Mike. I think we've just gone too far in terms of restrictive credit and risk aversion for borrowing. And there's a whole culture. And this started, of course, with those APRA actions in 2015. APRA perceived that there were too many investors in the market. They were worried about interest rates rising, which would leave over-leveraged investors in a precarious position, and that would influence our housing markets generally and then our economy. Of course, those higher interest rate, speculation of higher interest rates proved to be completely wrong. But it did start the ball rolling in terms of fear of investor activity, particularly, and that has continued to be enhanced. And even the Reserve Bank was on that bandwagon in terms of trying to control the number of investors in the market rather than having an action outcomes happen as a normal result, which it does and has in previous cycles of market dynamics. And then, of course, the icing on the cake was the Royal Commission last year, and that really was almost truisms that were starting to be thrown around about lending being too loose. And we really have no evidence for that, specific evidence, robust research to support that. And sense is prevailing now, and realising that this has now become a significant negative to our economy in times of stress as we are now. And all we have to do is look at the recent statistics, Michael, in terms of the proportion of investors in the market at the moment. For goodness sake, the market share for investors is the same as first home buyers at the moment. I mean, that's just ridiculous. And that's been the level of activity over the past year. And that's been falling like a stone since those restrictive lending policies were introduced back in 2015. So, yeah, good news there. That's not to say we should open the floodgates, but I think that we went too far one way in terms of restricting lending, and now we just get back to where we were before.
Well, the suggestion is that's going to be March, and there's some interesting thoughts about why the timing of that. Let's wait and see. The other big news, of course, is the opening of the Melbourne property markets. If you look at what happened in other states, there was a rebound as all of a sudden there was pent-up demand. And while there's already evidence on the ground of that, Andrew, I can't see it being as strong as other states in the short term.
Yes, Michael, look, that's true. And one thing we should recognise that sales transactions have still occurred during the shutdown. It's almost remarkable that despite what has been some of the severest lockdown policies in the world, that real estate transactions have continued to occur. Now, I think now that we're seeing an easing of these restrictions, that obviously transactions will increase. But I think the problem that Melbourne has compared to other capital city markets, and there's no doubt that other capital city markets, as we've seen week by week, are experiencing quite a healthy, typical spring selling season at the moment. Now, I think that's been helped by the fact that it was an autumn shutdown for those other capital city markets. So they sort of had June to think about things and to start to be a bit more relaxed about the outlook. So it was a good, I guess, transition into that typical spring vibe for buying and selling property. The problem with Melbourne is that by the time, fingers crossed, that we get back to more of a normal environment in Melbourne, the year will be basically past, and people will still want that Christmas breakdown, holiday breakdown reflection time. So I think the very timing of this, Michael, is against the type of, or the level of rebound that we've had in other capital city markets. I think it will occur, and it will be quite a healthy rebound, all things being equal, coming into February and March next year, because there will be a lot of pent-up demand. But I do think we're going to have to wait till then for Melbourne to start to really get the sort of transactions and volumes that the other states have been getting over spring, or are getting so far over spring.
I agree. With big week ahead, with the budget coming out. So I look
Yes.
forward to our chat next week when we'll see what little presents Josh Frydenberg has got for us. Thanks for your update this week, Andrew.
Thank you, Michael.